So, today we are going to talk about mastering your financial future, building wealth over time. And the reason, for the past few months, I think we started this in July. We've been talking about investment, we've been talking about stocks and things like that. But then this month, I thought we can take a break and talk about personal finance. And the reason I thought of that is this. So, as we've been talking about investment, we are all in different financial situations. There are people that would maybe their concern is, oh yeah, they understand they need to invest, or they are getting some of the strategies we are talking about, but to them, where's the money? That they don't have the money to start investing. They would love to invest, but the money is like as they are earning, maybe the money is going somewhere else. So I decided to talk about this today. We're going to talk about how we can manage money, how we can manage our income so that we can have enough money to save and invest, and how we can build wealth over time, and not just about investing, but generally how to manage our finances. So that's what we're going to talk about today. We will talk about how to be the master of our financial future, how to ensure that we have enough money to be financially independent, not just now, but in the future. But before we move on, as usual, we'll talk about Ivorian. The webinar is brought to you by Ivorian LLC, which is a registered company in the state of Texas. We offer personal finance consultation. We offer IT training. If you want to train to be a business analyst, a data analyst, business intelligence engineer, data engineer, we do all of those. We offer interview prep, especially technical interview prep. So you can reach us on ivorian.com, and if if you want to learn about like finance, you can go to ivorian.com/finance. And then we're also on YouTube, Ivorian Finance. So now we encourage everyone, please subscribe to our YouTube channel. And when watch as we share content, watch, share, and like. That will tell YouTube's algorithm that the content is good, and you'll be able to push the content to the other people. Um, Again, Ivorian Investment Club, there's free membership, and we are not like a typical investment club. We are not putting money together to invest. Each person is responsible for their own investment. Nobody's going to ask anybody to bring money. It's free. We'll we'll talk about stock markets, how to invest in stock market to make sure that you don't incur losses, and we'll talk about financial literacy as well, which is what we're talking about today. And we have our monthly meetings on the first Saturday of the month. So our next meeting will be on Saturday, December the 7th. And I will encourage everyone. I've shared the calendar invite with everyone. Please just add that to your own calendar so that you will always be reminded. I will still try to continue to be sending reminders to people. As time goes on, I will try to automate that so I don't have to manually send that. But if you have it on your calendar, it will always remind you. And then everyone must have received an invite to a Slack platform. I thought that it's good for us to communicate outside of the monthly meeting. So I'm going to be using that platform. We'll be communicating on the Slack platform. Um, and we can share different information, like let's say a company is going to declare any, let's say there is something going on in the stock market, or there's like a stock recommendation. All of those will be shared on the Slack platform. So if you have not accepted the invite, if you have not joined, I will encourage you to do so. But it's not a must. You don't have to. Yeah, the only thing is that some things, it's easier for me to just post something on the Slack than sending an email. And it's not just me, the Slack platform will allow everybody to share information. So I'll not be the only one sharing information there. Um, if anybody sees any opportunity that uh that will benefit people, you can share on that platform. My only ask is let's limit it to only things that have to do with investment. Things like happy new month, happy birthday. Let's avoid putting them on that platform. Let it be just strictly investment. And again, the although the investment club asks for membership, people have to register to be so that they can be notified of our meetings. So I'll encourage you to share the link, the registration link with people. You know, one thing I feel is I wish some of the things I'm teaching right now, someone taught me 10 years ago, 15 years ago. You know, I wish someone taught me, but I'm sharing some of the mistakes I made when I started investing. I'm sharing that with you. I'm being vulnerable. I'm not just talking about my investment success. I'm talking about the things I that did not go. I will be talking about the things that did not go well as well. A few meetings ago, I talked about I over diversified in one account, in one brokerage account, and that did not turn out well, you know. So like if you can share this group with other people, they can learn as well. You don't want people, just like I'm wishing somebody taught me all of this some years back. We don't in the next 5, 10, 15 years, we don't want someone to be wishing that in 2024 someone taught them. If we invite them, if they start with all of this, they learn all of these things, by then they will be glad that okay, someone taught them. And then, as I've always said, I don't want to be the only one teaching. If you know something, if you have a knowledge that you would like to share with people, please let me know and I'll give you the platform. One of the meetings you will share uh things with people. So please talk to me. And if there's anything we need to improve on, if there's anything you'd like us to maybe talk about, please feel free to share with me as well. Okay, so here's the agenda for today. We'll talk about financial planning, budgeting, saving, managing debt, investing, retirement, and then financial education. So let's dive in. I mentioned earlier that the challenge some people have is that by the time that they earn money, they get their salary, they pay their bills, they don't have enough money left to say to invest. They know it's important to invest, but they don't have enough money. One of the ways things you can do to manage your finances better so that you can, irrespective of how much money you earn, you can still save. There was a time, and my sister is on this platform, she can bear me witness. There was a time that I thought that because I was earning so low, I just could not afford to invest. She would tell me because we both grew up seeing our dad investing, and she would encourage me, and I was like, "You don't get it. I don't have enough money." But let me tell you, when I started investing, it was amazing where how I was able to manage, because I was able to, like, within the first year of starting to invest, I had up to half of my salary in my investment account. How did it happen? Not that I don't believe my salary increased significantly, but I changed things around. I started managing my money. Yes, so one of the ways you can manage your money is by creating a financial plan. A financial plan should be a written plan, not just something you have on your head. It should be a written plan. It should contain your net worth. Basically, your assets minus the liability. Your assets are the things you own. Maybe the money you have in the bank, maybe the investments you have, the things you own. Those are your assets. Your liabilities, on the other hand, are the things you owe. Maybe you owe someone money, maybe you have a balance on your credit card. So you basically subtract your liabilities from your asset. That will give you your net worth. So you should know your net worth. And also, you should set financial goals. So a part of your financial plan is to set your financial goals. And when setting goals, not just financial goals, generally when setting goals, there's this approach called SMART that people use to set goals. It's an acronym for specific, measurable, achievable, relevant, and time-bound. Now, when we talk about something being specific, what is it that you plan to achieve financially? Are you trying to save for an investment? Or you have something to do, you have something that you need to purchase, let's say in the next 6 months, 1 year, 2 years. Are you planning for that? There must be something written that you are trying to achieve. It must be specific. You must be able to state it. Then the next thing is measurable. Your goal should be measurable. You should be able to measure that, okay, this is the thing I'm trying to achieve. And by being measurable, you'll be able to track your goals over time. For an example is, maybe you want to save $100,000 within, let's say, some years or months, depending on your income. So you must be able to measure it. And every time now and then you can go back and say, how much of this goal have I achieved? Because it's measurable. Then it must be achievable. Look at the resources that you have available to you. Are you able to achieve that thing? You don't just there's this let me not say that, but at the same time, you just want to make sure that what you are trying to do is feasible. You can achieve it with the resources. You don't just wish. Look at what you have. Look at your resources. Look at everything around you. Is it possible to achieve that goal? Then the next thing is relevant. Your goal must be relevant to you. You don't want to create a goal just because you hear other people are creating the same goal. An example is this. You might hear people saying, oh, I retired at 40. I retired at 30. You don't want to retire just because somebody retired at a certain age. You have to look at yourself. Is it relevant to you? What is retirement? What do people do in retirement? Are those the things you plan to do in your own retirement? So, and I'm not just talking about retirement now. I'm talking about just everywhere. Like, is it relevant to you? Think about it before you set a goal. Then the last thing is time bound. You must set a time within which you need to achieve your goal. I understand that things change. You might set a time right now, and for whatever reason, maybe you are not able to achieve it within that period. You can still go back and adjust the timeline. But by not setting a time, you are just making your goal. Your goal, you can have you can't be able to even track it to know, okay, how much of the goal have you achieved? Let's say half of the time has passed, you must be able to, you must have achieved something. But when you don't have a time for it, you can't have a clear goal. So the next thing is having created a goal and with using a smart method, you need to go back and every now and then, maybe every month, maybe every quarter or something, you need to go back and see how much of that goal you have achieved. If you think that it's no longer feasible to achieve it within the time you have set, you can change the timeline. If you think that, okay, there's something else you need to do for you to achieve it, then you can go do that. And another thing is that you may want to break down your goal into chunks. Maybe initially you say you wanted to save 100,000. Maybe you want to start with 10,000 first. Make your first 10,000, then okay, maybe 30,000, then maybe 50,000 before you go to 100,000. As they say, that Rome was not built in a day. It's always good to start small and you can adjust accordingly. Now, again, apart from I've talked about a financial plan having been a written plan, having your net worth, it should also include your income and your expenses as well. The debts you have should also be included in your financial plan. The assets you have should also be included in your financial plan. And if I can say something about goals as well, one of the goals you need to set is the goal for retirement. What do you want to do in retirement? You need to set a goal for that. So your goals can be short term and long term. But the most important thing, it could also be medium term. The most important thing is to have that financial goal. And if it is something, if you need help, you can reach out to people that can be able to help you with a financial plan. In actual fact, if you have used some brokerage app like Fidelity, Fidelity will help you to create a financial plan. That will help you. Then the next thing is to budget wisely. You don't want to just be spending because the money is in your account. A budget can be used to track your income and expenses. You need to be able to understand how money is coming in and how money is going out. What category of expenses do you spend most of your money on? Do you spend your money on the assets that don't maybe benefit you that much? Maybe you even have a subscription that you no longer use and you still pay for it every month and you don't know. Those are the things you have to add in your budget. Every month, you can have a monthly budget, you can have a quarterly budget, or well, I wouldn't say yearly, that's too long, but a monthly budget will be ideal. Then you need to determine your financial priorities. What is important to you? You have a list of expenses that you have been tracking. Which expenses or what thing is more important than the other? Can you do without an item that you've been spending money on? Again, like I talked about subscription, apart from subscription, that other things that people spend they spend their money on and they do not even realize, or maybe they don't realize how much money they are spending on that thing until they start to track their expenses. So check. Can you do before you buy an item, you should ask yourself a question. Can you do without that item? Or can you postpone buying another item until later? Does that item lose its value over time? Or does it appreciate in value? If it loses value, like, okay, what's the rate at which it loses value? What benefits do you get from that item? Those are the things you need to ask yourself before you spend money. Having said that, I'm not one of the people that will say just be saving, just never spend. No. If you work hard, you should enjoy your money as well. So there are times that you need to treat yourself. Maybe you need to go on a vacation. Maybe you need to go enjoy a nice meal. We'll talk about treating yourself well. We'll talk about like maybe even managing health and things like that. We'll talk about that later. But then in creating a budget, you can use a budget app. There are budget apps out there. There is one called You Need a Budget that you can use. There's Every Dollar Budget. There's Mint. I think Mint, they are saying the developers are ending it. I'm not very sure, but you can check it out if it's still available. One thing you want to do is before you decide on a budgeting app, make sure you read the reviews, especially if you are going to link it to your bank account or your credit card account. You read the reviews well, make sure it has good reviews. But apart from that, you can also have use budget calculators. In actual fact, some bank accounts will let you. I mean, some banks have online budgeting tools. They will track how much you are spending. Like if you let's say you have a checking account where your money comes in, money goes out, they will track it for you. You can use those as well, or even credit card. Monthly, you should look at a credit card statement to see where your money is going. But if you can't afford, there are free budget apps that are paid ones as well. Same with budget calculator. But if you cannot afford to pay, or you just don't want next day you can afford, you just don't think you want to pay for it, you can make use of templates, spreadsheet templates. There is a Microsoft template. Let me see if I can the link. Maybe after the session, I can put it in the chat or I can send it. There's a spreadsheet template that you can download and you can use that to create a budget. Now, your work does not end when you create a budget. You still need to go back and continue tracking your budget. Continue tracking your spending and adjust your budget as needed. Now, before you create a budget, that's why the first bullet here is to track your income and expenses. Before you create a budget, you need to have a list of your expenses. Maybe you want to look at your credit card in the last 1 or 2 months, or your bank accounts in the last 1 or 2 months, and see where you have spent money on recently, and use that to create a budget. But there are things that maybe you've not spent money on recently that could come up later. So because of that, you periodically change or adjust your budget as needed. Now, saving consistently. It's important to save. That's the golden rule or rule of financial freedom is to never spend more than you earn. It doesn't matter how much you earn. Maybe you, just like I shared my own story with you earlier, how I thought I could not save because I was earning so little and I had a lot of expenses. No matter how much you earn, you can still save. That was one thing I did not think, and many people still do not. Never ever spend all of your income. Every month, there should be a specific amount that you set aside as saving and investment, or a percentage of your income that you direct every time you earn paycheck, you get your paycheck. Now, I understand that There are people that maybe, okay, yeah, they get two paychecks in a month. Maybe the first paycheck goes into all of the bills. Then make sure that out of the second paycheck, you set some money aside as savings and investment. Now, it's not the amount that matters, but the consistency. Now, if you don't already have a savings culture, the first place where you need to start is to have an emergency fund. It is recommended to have at least 3 to 6 months of expenses as an emergency fund. Just in case anything happens, you lose your income for some time, you will have something to live on. So where you want to start is to have an emergency fund. It could be more than 6 months, but the recommendation is at least 2 to 6 months, so you can have something to live on. But after you create an emergency fund, the next thing you need to do is to have a savings account if you don't already have one. You don't want to save in a checking account that you use for everyday spending. You stand the risk of spending your savings if you do that. You need to have a separate savings account. Go to your bank and tell them you need to open a savings account. For many banks, you can even do it online. It is in that savings account that you save money, and make sure that it's an account that you will not just dip into at random. In fact, most savings accounts have a required maximum number of times you can withdraw in a month. Most savings accounts have about like 6 times. After you withdraw for more than 6 times, they will give you a warning. If that keeps happening in other months, they can close your account. Because the purpose of savings is of a savings account is not just to be taking out money every now and then. Now, most savings accounts will give you interest. However, the interest may be really, really small. In actual fact, as of yesterday, the average interest rate for savings account was 0.45%. That's really, really small. That's why I listed another kind of savings account, a high yield savings account. It could have as much interest rate as 4% or even 5%. One thing I've noticed is that many times when you go to your bank and tell them you need to open a savings account, they won't tell you about high yield savings account. They will just open a regular savings account for you. But when you go to your bank, ask specifically for high yield savings account. Another account you can save in and have that has high interest is the money market account. The interest is higher than the regular savings account, but not as much as high yield savings account. Then the last thing here is to automate your savings. Don't trust yourself that you will always remember to transfer money from your checking account to your savings account. Automate your savings. What I do every month, I've automated my finances. Every month, as I'm getting paycheck, a certain percentage of it goes from my from my regular checking account into my high yield savings account. Another percent goes to my money market account. Another percent goes to my robo account. I don't even see it. That's the best way you can manage your finances. Why is it that people don't default on taxes? Because before you get your paycheck, they've already taken the taxes and you are able to manage anyway. I can tell you that if you automate your savings and before you get the money is transferred into your savings account, you will still live for the month, one way or the other. Maybe you have to cut your expenses, certain expenses that are not very important, you may have to cut them, but you will still live for the month. Manage debt. A debt is any amount you owe an individual, a bank, or an entity. And it could be in form of credit card debt, student loan, personal loan, car loan, mortgage, and so on. Now, it's so important to manage your debt. And if you are in debt, it's important to get out of debt as soon as possible. Remember that you are paying interest on the debt every month. And it's so funny that when you put money in your account, in your savings account, they give you like 0.45%, as I mentioned earlier, as interest. But when you owe bank money, the interest could be as much as high as 30%. It's a lot of money that goes into servicing debt. So if you're in debt, you need to plan to get out of it as soon as possible. There are two general ways to manage debt. One is the debt avalanche, and the other one is the snowball method. For the debt avalanche, meanwhile, before I go into that, I talked about savings in the previous slide. If you go on my YouTube channel, you see some videos about financial freedom where I talk more about savings as well. The same thing with debt management. I actually have a video on debt management. Now, for debt avalanche, you pay off the debt with the highest interest rate first. Meaning that, okay, you have a minimum balance you should pay every month. Now, the one mistake people make is to pay only the minimum balance. When you pay only the minimum balance, your debt will remain for a long time and you pay more in interest. But pay more than the minimum balance and with on the debt with the highest interest rate. And when you pay that off, go to the next debt. If you have multiple debts, go to the one with the next highest interest rate. Pay more on that. You pay it off, go to the next, and so on until you pay off all your debts. Now, the advantage of that is that will reduce the amount you pay overall in managing debt. But the disadvantage of that is that if the debt with the high interest rate, if it's a lot, people may not see significant progress as they are paying. They may not see significant progress on it, and that could discourage them. The snowball method, you pay off the debt with the lowest balance first. And then you go off on to the debt with the next lowest balance until you pay off all your debt. The advantage of that is that you can easily see your progress, and that could encourage you to pay it off more. But the disadvantage of that is that the debt with the lowest balance may not be the one with the lowest interest rate. So you choose the approach that works better for you. Now let's talk about credit cards. When it comes to credit card, most people are on the extreme end of the spectrum. Some people will tell you never use credit card. It's so bad. Cut your plastic. Some other people will tell you, oh, credit cards are good. You can what's it called? You can pay for something now, buy something now, and pay later, and you can your credit rate will improve when you pay with credit card and you pay off. So people are usually on those two extreme ends. For me, I like to stay in the middle. Credit card can be good for you and it can also be bad, depending on how well you are able to manage the credit cards. Now, if you are the type that every month you pay off your credit card, you pay off the balance every month, you can't carry balance from one month to the other, the credit card could be good for you. In that way, if you pay off every month, you won't be paying interest on it. And also, if you are the type that, okay, you know the due date. One mistake people make is that they forget to pay their credit card on the due dates. And your bank will charge you late fee. And not just that, they can report it to the credit bureau. And that will have negative impact on your credit. You were trying to use credit card to build credit before. Now, by paying late, it can have negative impact on your credit. So if you are the type that when you use it, you pay it off on time, you don't carry balance, credit card could be good for you. You can use it to build your credit. And another thing is that some people, just because they have credit card, the money is not that they are taking the money out of their account. It could encourage some people to spend unnecessarily. If you are the type that spends unnecessarily because you have a credit card, maybe credit card is not for you. Or if you don't pay off, or you occasionally forget to pay on time, maybe credit card is not for you. So if you are able to manage your credit card well, you should have a credit card. If you are not able to manage it well, and it's putting you into more debt, maybe it is time to cut your plastic. Now, in managing credit card, one thing I used to do was, like, I have people, I hope people don't scream. I have at least 7 credit cards for different purposes, and I never pay any fee on any one of them. Now, one thing I used to do is I have a notification. I have a calendar notification that reminds me 3 days before a credit card bill is due. It will remind me the day before and on that day, so that I go pay it for every single credit card I have. That's what I used to do. Or even a better approach that I use, and in actual fact, apart from just getting the notification, I know offhand the due date for each of my credit cards, so that I don't miss the payment. And another thing is that before I use my credit card, I make sure that I have enough money in my account to pay for it, so that I will not have to pay interest. But what I do these days is that I actually pay my credit card. Like I mentioned earlier, I've automated my finances. It's not just savings, even my bills, like credit card bills, I've automated it. I don't have to log into my account. Everything will be paid. The statement balance is paid in full every month from my checking account, so that I never miss payment. And I always pay the full amount. Now, that doesn't mean I don't go to manually check my account. I still go to check to make sure that somebody has not used my credit card to pay for something, or somebody has not charged me more than I paid for it. I still go in and check. So it's either, if you want to manage your credit card, it's either you automate the payment, or at least you have a notification on your phone that reminds you. But if you cannot do all of those, if credit card is putting you into more debt, I would say cut it, or call your credit card company and terminate it. Oh, sorry. One last thing before I move on from that. You need to be careful with credit restructuring. There are agencies out there that will tell you that, oh, you're in debt. They will don't pay, stop paying. They will reach out to the agency to cancel the thing for you, or maybe to negotiate a lower interest rate for you. I won't tell you to not necessarily use them, but what I will say is be careful with them. Some of them will tell you to stop making payment, and they may not do anything. Remember, the debt is not theirs. The debt is yours. It is your responsibility to make payment. I know people who are in big debt because they stopped making payment because an agency told them, and the thing has accumulated a lot of interest. So just be careful. And even balance transfer as well, be careful with that. Now, invest after you have saved money, invest for growth. When it comes to building wealth, it's not just enough to save. Like I said earlier, maybe if you have an IG savings account, the maximum you get is like 4-5% interest. But if you really want to build more wealth, you invest in assets that will give more yield. So it's impossible to invest in like stocks, in bonds, in real estate. You diversify by investing in different assets. Then plan for retirement. This is a big mistake many people make, especially those of us that come from Africa. Maybe in Africa, maybe you are working with government that will pay you pension and gratuity, and you get here and you just forget that you have to prepare for your own retirement. It's also hard to know that many people don't have retirement accounts. There are people who work in places that their employers give them opportunity to have retirement account, yet they don't do it. The first thing, if you don't have a retirement account, you need to go open one as soon as possible. It could be 401k, 403b, or whatever they give in your place of work. And if your place of work does not offer a retirement account, go open an IRA. IRA stands for individual retirement account. You can open with your bank or with a brokerage app. Then contribute consistently. This is especially important if it's an IRA that you are the one that contributes into it. You have not, it's not like something that comes out of your paycheck. It's important to be consistent. Then, if your company offers a match, make sure you maximize it. This is another mistake people make, and they are leaving money on the table. Some companies will match when you put money in your retirement account. Some company will match it, maybe 1%, 2%, 3%, 4%, even 6%. I know I've worked with a company that matches up to 6% before. So one mistake people make is that they don't contribute enough to be able to maximize the matching. Make sure you contribute enough to maximize that. Now, it is recommended that up to like 16% of your income should go gross before you take taxes and all of those should go into your retirement account. However, if you cannot afford to put in up to 60%, just start somewhere. But I would recommend that every year increase it by like 1%. Keep increasing it by 1% until you get to 16%. That doesn't mean you cap it at 16%. If you can afford to contribute more than 16%, that would be perfect. But that's an ideal number. Then understand taxes. It's a mistake to just be investing and not think that at the end of the year you pay taxes. Even something as small as just putting money in a savings account, the interest you get there, at the end of the year you pay taxes there. So take note of that, especially when it comes to like trading. When you are trading, take note of the taxes you are going to pay on that. Now, capital gain is when you sell an asset and you make profit from it. That's called capital gain, and there's capital gain taxes. Now, the way you are taxed on capital gain depends on a lot of factors, like how it could be short-term capital gain, it could be long-term capital gain. The rate is different, and it also depends on how much you make in a year. We will have a session where we talk more about capital gain taxes. It's also important to utilize tax advantage accounts. There are some accounts or assets where you invest before taxes. There are some you invest after taxes. We'll talk more about that. There are situations where one is better than the other. And also there are some investments that have better more tax advantage. Like, for example, if you are trying to compare ETFs and mutual funds, when it comes to taxes, ETF is better than mutual fund because they don't distribute as much capital gain as mutual funds. But again, we'll have another session where we'll talk about ETFs and mutual funds. Another strategy is tax loss harvesting. While it may not sound like a good idea to sell an investment at loss, it could actually be a strategy. And by the way, let me tell you, when you are investing, there are times you will make profits and there are times you will incur loss. What you want to make sure is that you make way more profit than the losses you have. Because you never can, anything can happen. You can have a good company and might have invested in a good company. It's going up, you're making a lot of money. Something just happens to the company one day and the stock price just goes down. So yeah, one way or the other, you will incur losses on some investment. But one strategy is called tax loss harvesting. When you sell stocks at loss to reduce the capital gain taxes you have to pay. And again, we'll talk more about taxes. I'll show you how tax loss harvesting can help you not just with the capital gain taxes, but with your income tax. You can take as much as 3,000 out, but we'll talk about that some other time. Then it's important to protect your wealth. Some people make the mistake. I talked about this last month about checking your portfolio regularly. It's a mistake to just invest and forget about your investment. Even if you are investing for a long time, you are investing for retirement, you still need to go back periodically and check how the investment is doing. For most investment account, you have funds that you invest into. Maybe that fund is not doing very well and you need to reallocate your money into another fund. Or maybe the expense ratio is too much or the administrative fee is too much. You should regularly monitor and manage your account. You can manage yourself or you can have a professional management, but mind you, you'll pay for that. You could also have robo investment. Robo means a robot. Like a robot may be basically not, it doesn't have to be a physical robot you see, but basically like AI. You use AI that trade. I actually have a robo investment account and it does really well. All I have to do every month, like I mentioned earlier, when I get paycheck, a percentage of my money income is automatically transferred into my robo account. And I don't have to worry about what stock I buy or what stock I sell. That is done for me automatically. Now, periodically, you may need to reallocate your asset from one that is doing well to another one that is not doing well. Even if a stock or an investment is doing well, there are times that maybe you have too much concentration in it and you need to reallocate in order to hedge against potential losses in the future. Then it's important to set your stops. We talked about this last month about setting stops. Setting stops can help you in terms of protecting your profit, but it can also help you to reduce losses as well. And again, maybe one more time we'll talk about it. Then it's important to invest in FDIC insured asset. FDIC means Federal Deposit Insurance Corporation. If you you invest in CDs or you have a savings account in a bank that is protected by FDIC, your money is protected up to $250,000. In the event that the bank fails, you will still get your money. But if your investment is not protected by FDIC, the bank fails, your money is gone. Then it's important to have insurance coverage. You may want to insure and protect yourself, or you may want to protect your assets. Then continuously educate yourself. Don't just invest haphazardly. Learn how to invest, which is what we are doing on this platform. You know, apart from the things I talk on this platform, if you go on my YouTube channel, there's also important. There are videos that talk about investing, there are videos that talk about general personal finance, and I'll keep making new videos that you can watch. So it's important to keep educating yourself, stay informed about the market, know what is going on in the market. One mistake people make is that maybe they have a stock, or their general their portfolio is going down, the value is going down, and they just go sell. They don't understand that it's the general market, it's not just them. So it's important to stay informed. Read books, attend seminars, to learn more about stocks, and learn from people. If you know people who are doing well in terms of finances, or in terms of their investment, learn from them, learn strategies from them. And lastly, it's important to learn from your past mistakes. One time or the other, you will make a mistake. You can do something now that you think is a wise decision, but tomorrow you may discover it's not the best decision. Learn from that so that you can don't make the same mistake over again, and learn from the mistakes of other people. That's why I'm telling you some of the mistakes I made, so that you don't make the same mistakes. Okay, that is it for this month. If anybody has any question, I'll be glad to answer. Any question? Anything you'd like me to go over before we end the session today?
Okay, when you were talking about the credit card management, I just want to go over, because when you get a credit card, they will tell you that okay, zero annual fee. Then they will say okay, maybe 27%, 90, depending on the percentage.
Yes, sir.
After, some will say 18 months, some will say 12 months. So the question is, if you didn't pay up your balance when you have like maybe 18 months or maybe 12 months before they start charging, would they, if you did pay, if maybe you didn't pay all your balance that month, would they still charge you interest since
Yes.
you've not finished your initial 12 months?
Oh, if you have not, okay, so let's say they have 12 months in the introductory period, and
Yeah, if you are still at introductory months.
yeah, within those period,
Yes.
if you don't pay, there's like let me be sure I give you the right information now. So yeah, your rate is 0% within that period. Yeah, they will not charge you interest for that period.
Okay.
For that 12, if it is 12 months, you carry
Okay.
your balance, they will not charge you. But the credit card issuers are wise. They understand that most people will not pay it off within the 12 months. And what they do is that if you don't pay off within, let's say you not pay it off in like after let's say after the 12th month, you still have, let's say for instance, you have $1,000 left on the credit card. You will think that they will only charge you interest after the 12th month. The interest they will charge you will be from the first day.
I get you.
Not after the 12 months. Yeah. Yeah.
Okay. All right. Yeah.
That's what they do. So that's
So for what you are teaching us, you have to be on top of your game. Know the information. When you get any card, know all the vital information, the dates that each of those things will kick in.
Yeah.
Because that's the problem. Because most people don't know the date that they are those interest rate will kick in.
Yeah.
So they will think, oh, you see, by the time you forget about it, it will just kick in, and that's it.
Exactly.
Thank you so much for
You're welcome, sir. Any other question? Anything you'd like me to?
I wanted to ask,
Yes, sir.
where can we find out the list of the banks that are in the list of FDIC? Where can we get the list?
So it's not that the list is just somewhere, but when you go, let's say you want to open a savings account in a bank, go on their website and check. Most website, let me see, if I can pull up something. Let's say we go to pnc.com, for instance. Most bank will write it somewhere that they are they are protected by FDIC. Yeah, you can see this is pnc.com. FDIC is a member of FDIC. So if you plan to open an account in a bank, just search their website and check if they are protected by FDIC. Or you can call them, or you can work in a bank and ask. So now here they have said is a member of FDIC. So if you have savings and all of those, that it's protected. But see a caveat here: PNC investments are not insured. The money in a savings account is insured, but if you have PNC investment, they are not insured by FDIC. Well, not all of them are not insured. There are some of their investment. I actually have an investment with PNC that is FDIC insured. But those are the things you have to ask. When I actually invested in that product, one of the things I asked the representative that spoke with me, I actually met with them maybe 2 or 3 times before I put my money in there. And I asked, is FDIC insured? They gave me some options. There's one that pays really good interest rate, but it's not backed by FDIC. I said, nope, I cannot joke with my money. I picked the one that is backed by FDIC. So yeah, the short thing is that the summary is that go to their website and search for FDIC. You see it whether or not they are backed by FDIC.
Sorry, as a self-employed, can you open a 401k for yourself if you are self-employed?
I don't believe you can open 401k, but you can open an IRA. You can open an IRA. But if your business,
I can chime in really quick.
okay,
You can actually open a 401k
okay,
if you work for yourself. Yes, it's called
okay,
something like self-employed 401k. They call it solo 401k.
okay,
Yes, if you Google, because I have an LLC, I have a business that I run, and I've looked into that. um yes, and it even has more tax advantages than the normal 401k that W2 people have. So yes, if you Google it or go to YouTube, you'll find lots of information. But yes, you can open, it can either be a solo 401k, and it can also even be a solo Roth 401k where you pay after taxes, whichever one suits your situations. I just wanted to chime in there.
okay. And by the way, she has worked in a bank, so you can be sure she's giving you the right information.
Okay, thank you.
You're welcome. Yeah,
You're
but in
welcome.
case you don't want to open that, you can open an IRA as well.
So if I want to open an IRA, do I need to go to the bank, or can do that online myself?
You can do it online, and it's not just with a bank. Some brokerage firms offer IRA as well. For example, Fidelity offers IRA. I'm not I think Weibo has IRA as well, I think, but I'm sure of Fidelity. So it doesn't have to be a bank. So if you want to open with Fidelity, just go online and open it. But if it's a bank, I'm not sure if you have to go to the bank or you can open it online. But first check online. If you see an option to do that, do so. If not, then go to the bank and open it.
Okay, thank you.
You're welcome. And I'm sure Fidelity will have the solo 401k that my sister talked about as well. You can look at that. I've never heard of that up until today. So I'm glad she's there to correct me.
Yes,
Yeah,
Fidelity has a
and
IRA.
Sir?
yes,
Fidelity has IRA.
Yeah, Fidelity has IRA.
so for the self-employed one, you may have to pay. I'm not really sure. I spoke with a representative from a company that was asking for like $99 a year. But look into Fidelity and look into Schwab. I actually worked for Schwab like on this particular project, I worked for Schwab for like almost 2 years. Look into Schwab, look into Fidelity for solo 401ks. But you might also run into companies that actually charge like a yearly fee for it.
Okay. Okay. Thank you.
Mm-hmm.
Yeah. Any other question? Okay, we'll end that today. From next one, we'll go back to talking about investments.